you had all these folks raise money. You had some really questionable sponsors, to be completely honest with you. I'm not going to call any of these guys out because I don't want to give them any airtime, but you literally had people who ran companies into the ground, people who were kicked out of their companies for, sexual impropriety. It didn't matter. Any random dog and cat was able to raise a SPAC in Q1. And now on the back end, you're going to start seeing some real difficulty. So deals are getting retraded constantly, which means that, IPOs that should have been done at price X is getting discounted by 20 and 30% to get the deal done. There are all kinds of side deals getting cut left and right. And this is just the beginning. And the reason is because that Friedberg, how much did you say? 265?
100 there was about 110 billion raised in Q1. It looks.
But how many deals? 260 deals?
298
were
raised
almost
in Q1.
300.
So those 300.
248 in 2020. Just
so we're still in the first inning, right? If you think about it, these SPACs have 2 years to put the money to work. So we're only max 90 days in to a 2-year shot clock, a 700-day shot clock. And so you're going to see some really crazy behavior, I predict, in November of 2022, right? Like the last 6 months leading into the expiration of all these SPACs. And between now and then, I think the market is really going to hold people accountable. So like when we see a pipe opportunity now, we're incredibly firm on hey, listen, the 2025 projections, we're going to back off of those. We want to see 2023 numbers. We're going to price it to that. We're going to price it with a margin of safety. And so these people come back and recut the deals constantly. There's a situation where this one deal retraded 3 times before a price cut. Done. And it was ended up being 35-40% below where they started.
I sent Chamath a note I got this morning from my friend who works at one of the banks and one of the bulge brackets, and they said there was 50 pipes in the market last week, and they think only 5 of them are going to get done. 50. And Chamath, what, a quarter or two ago, 100% were getting done or 80% were getting done, right? I mean...
Yeah, and I'll quite honestly, they were meaningfully oversubscribed. And now we're demanding, the people that look at these pipes, I'm one of them, but so I've talked to some other people who do it, and we're all in the same situation because we're demanding much better terms. And so the pressure is gonna come on not the founders and the companies, but it's gonna come on the sponsors, because I think sponsors will really have to put up a lot of their money to get these deals done. And this is where you're gonna separate the wheat from the chaff, because most of these sponsors are doing it for a quick buck. And you'll see, without debating who you think it is, when you see people unable to post the money to get a deal done and that deal go away, that is the charlatan.
Right. Chamath, it seems like there's also a deleveraging happening with the funds that bought a lot of these SPACs and de-SPAC listings in the aftermarket, right? Which kind of creates a bit of a logjam on the back end for a lot of these.
So, it's for those that are interested in some of these market dynamics, one thing that I have learned in the last little while is that depending on who you are, risk is managed really differently. So, for example, there's a friend gave me this language, and I'm going to repeat it because I think the way he said it was very elegant. There's what's called inception to date risk, and then there's year to date risk. So what is the difference? If you're a hedge fund, you're really in the year to date business, meaning how am I doing in this current moment in time? Because your compensation is driven from that. And so you're very much forced to manage short-term volatility in your portfolio. And a lot of it is very parametric. When, something goes down by X%, then you have to sell. And then if something goes down by Y%, you sell more. And if something goes down by Z%, you have to shut the position out. And those are extremely codified. And so when you have a lot of hedge funds who are parametrically running year-to-date risk, and you have, all of a sudden, the threat of inflation, bond yields go up, factor rotation out of tech, it's a running to the exits. Then you have other people who manage what's called inception to date risk. I would say Buffett is in that category. For us, for the most part, we are inception to date risk because we don't have external LPs. And so you can manage these different risk buckets differently, but you have to appreciate that a lot of this volatility is a lot of year-to-date risk. Now, then you layer on top of it these exogenous events like what happened this week with Archegos, and it's just absolutely incredible because it just further amplifies all these people who would otherwise have made very rational decisions, forced to make irrational year-to-date risk management decisions. And that's what causes these massive swings and all this malaise in the market.
Sachs, what are we seeing in private company valuations. I know that while we're seeing the retreat in Chamath's part of the world and people buckling down and maybe some more guardrails, if we will, or maybe a tighter screening process for these companies going public. You didn't say Fisker, Chamath, but that was the one that had me like, what? Fisker? Didn't they fail twice already? What are you seeing on the private markets, Sachs, in valuations?
It's a very frothy time, to be honest. I think valuation levels are, they're probably the highest I've seen. I'm seeing seed deals now, hot seed deals, not every seed deal, get done in the high 20s.
This is pre-revenue.
It used to be. Yeah, pre-revenue. It used to be that I remember when pre-revenue seed deals were more like a 5 to 10 cap, and then like if they had a little bit of revenue, it might be a 15 cap, and like the hottest company out of YC
just
might be like
explain what that means, Sax.
The hottest company out of
a cap.
When you say
the cap is just a valuation. It's a $15 million valuation, effectively. It's just done on a convertible note called a SAFE. So it's, but for all practical purposes, it's a valuation. So it used to be, pre-revenue seed deals used to be in the $5 to $10 million valuation range. Then, a little bit of revenue be 15. The hottest YC deal might be an $18 to $20 million valuation. Now we're seeing hot pre-revenue seed deals going for like 27 to 30.
And what amount of capital is going into that round?
It's usually like a 10 to 20% dilution event. So it's
3 million to 6 million.
Yeah, exactly.
And they're not calling this the Series A. They're still calling this the seed round.
It's the first money in the company, so it's still a seed. And we also do obviously A and B and increasingly some growth investments. The price levels are basically double where they were just, I would say, like a year ago. These same seed deals.
Same thing I'm seeing. And it's making me think, as a private market investor, that maybe the right thing to do is to stop investing in as many new companies and work with the existing portfolio to raise capital. So I told my team, let's go through the portfolio, let's see who needs capital, and let's help them shore up their balance sheet when the market's hot and valuations are high, as opposed to going and trying to get into every deal. So I think I'm going to do maybe 30% less deals and redeploy my time at getting the current portfolio cashed up, and it's working. What do you think of this strategy, Chamath or Sachs or Friedberg?
I personally like it. I think that venture investors are typically trained. I was trained this way early on, which is to invest through the cycle, right? Just to think about this as a constant patter of capital. And to be honest with you, I have issues with doing that, Jason. And so I more agree with what you're saying, which is that I think like active risk management, especially I guess if it's your own capital, but I just think active risk management is important. It's important to acknowledge that the incremental SaaS company may not be that great as it is. And so at 30 pre, maybe really stretching the bounds of reality.